There's no time like the present to get involved. And the demand for all of these assets for the different reasons by the different power players in the world is not going to go away.
Yeah.
And the supply cannot meet that demand quickly once it starts to deplete. And that's across almost all of the assets. So we really need to, as investors, be aware of the fact that the train has not actually left the station yet, and you can still get on it.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are here at the 2025 Rule Symposium in Boca Raton. I'm here with Dr. Nomi Prins of Prinsights Global. Nomi, thank you for coming back on the show.
Thank you so much, Steve. Great to be back.
Pleasure is all on this side of the table. Let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Well, we've certainly seen new highs in the S&P 500 and the Dow. I have also seen, as we witness, real new highs in commodities, for example, gold in particular. I see that continuing. I see the economy stalling globally. We've already seen a 0.5% negative GDP for the first quarter in the United States. That's not a good way to start a year. But I do see the markets continuing to rally, even with some volatility, and in particular in the commodity sectors, in the hard asset sectors, and with respect to the companies that either produce or move or utilize hard assets. So real stuff is going to come to the forefront.
Okay, so you see basically a slowing in the economy, but with new highs in gold and commodities, you see essentially that the real assets should do well,
regardless of the fact that we're now in a lower economy, because they have necessity value, and they have value in terms of geopolitical power and also their use values.
Okay. You've warned of permanent distortion. What signals should everyday people be watching for to kind of know when the system is starting to break down? Or are we seeing that now? Or
we're seeing some of that. We're certainly seeing banks buckling under the weight of non-performing loans, delinquencies. The U.S. consumer is facing record personal debt, record auto loan debt, record home debt at a significantly higher cost of servicing that debt than we've seen ever before. So there's a lot of pressure on the consumer, and it's important, if you are a consumer and you have a lot of debt, to try and prepare for the fact that you need to get out of your debt. That's easier said than done, but one way to do it is to invest in things that do appreciate relative to that debt with any excess money you do have, which again is hard assets. But if the economy continues to weaken, I do expect to see rate cuts coming in from the Fed. We haven't had that in the first half of the year. There are still multiple FOMC meetings to come. And I think Chairman Jerome Powell is in a bit of a bind, because on the one hand, he doesn't want to cut rates or do QE and buy more treasury bonds because he doesn't want to look like he's capitulating to the White House and to President Trump. On the other hand, we are seeing the slowing down of the economy. We are seeing a rise in unemployment rates to 4.4% last month. And that will mean the Fed is going to have to come into its role regardless of inflation and look at that weakening economy and potentially cut rates. I would not be surprised to see the first rate cut of the year come at the next FOMC meeting.
okay, when you say banks are starting to fail, do you mean like commercial? Do you mean residential? Like which loans are not?
Yeah, it's for the most part commercial loans. And when we talk about, I mentioned, the permanent distortion that I write about. What permanent distortion really is when financial assets, paper, banks, financial institutions tend to run more quickly than the real economy. So again, when the economy is slowing down, but banks are continuing to give out loans, they're continuing to see problems with their loans, particularly in commercial real estate and some corporate loans that are related to commercial real estate. And they try to cover up those loans or extend them into the future, rewrite them, but the losses still accumulate. That's a problem.
Okay. What you mentioned about this consumer is interesting. My last guest, Rich, he sells precious metals, and he said that the most people that are coming in and selling him precious metals, they're paying off debt. I'm like, that's not good. You're paying off credit card debt.
That's right.
Yeah.
That's right. What's happening, because rates are the longer end of the curve, which is where banks and credit card companies mostly price the cost of carrying a credit card. So your monthly interest rate payment, some of which are 29%, 27%. It's very high to carry debt.
Yeah.
And the longer you carry debt at those higher rates, particularly in credit cards, which is the most expensive kind of debt to carry,
Yeah.
even making your minimum payments becomes onerous because you have to pay that 30% of them in interest effectively before you start, and then you have the payments. So what people are doing is trying to figure out, well, how can I make payments? I mean, the Treasury Department, in the U.S. Congress and the White House is grappling with this at a bigger level, $37 trillion of debt hanging on the U.S.'s balance sheet. But for people, where do you get that money? You can't sell your house right now because the market is actually softened, and interest rates are relatively high for mortgages, so people aren't really moving real estate or taking on new mortgages at the higher costs. And you have credit card debt. How do you pay that off? Well, you sell assets. What assets can you sell? Some people are selling some of their more luxurious or precious metal type assets. It's not the right time to do that.
Yeah.
But the problem is, if the consumer is in a bind and needs to come up with capital, needs to come up with money to just pay off debt, and those assets are available, and prices for gold are high, well, that's where you can get money. It's not the right time from an investment in gold perspective, but it's almost like, well, where else can you go? So that is happening to an extent with the consumer, to the extent they have availability of gold, availability of silver. But on the other side of that, it is squeezing the consumer because inflation has still been increasing. Now, it's increasing at a slower rate, but it still means prices are going up by 2-3% a year. Wages are staying where they are. The cost of paying off debt has risen significantly, and that does create a real bind for the consumer, which is the backbone in the U.S. in particular of GDP. It's 70% of GDP comes from consumption.
Okay. You also mentioned rate cuts. What's the market saying right now? How many rate cuts? What's the percentage going to be? And what do you think?
So the market is currently pricing about 50 to 75 basis points of rate cuts if you look at the Fed funds futures rates between now and year end. I actually think it can come in higher than that. I think we're looking more 75 to 100. Again, I think that Powell's in a bind and just doesn't want to do it when it seems like he's doing it to give in to President Trump. But on the other hand, these other numbers exist. Consumers are stretched. Banks are looking at delinquent loans and delinquent credit card payments. They don't like that kind of thing. The Treasury Department is basically dealing with heavy amounts of debt and having to pay basically into the interest payments for that debt at higher levels. That all costs the country money. The Fed's been ignoring this because it has hoped that the 100 basis points that were cut last year will have a knock-on effect of cutting the rates of the longer bonds. So if you cut them at the front end, the back end will follow. It hasn't followed. So they're in a bind where they need to figure out how to make it actually follow. So either they're going to have more quantitative easing, they're going to have to purchase more treasury bonds in order to put some value into that 10-year sector, or they're going to cut rates because growth is slowing and the jobless rate is increasing. So I think we will see 100 between now and year end, but I think it's going to be sort of a fall type of event.
Yeah. Okay, let's say we do get 100 by the end of the year. What do you put the 10-year Treasury at if that happens?
Okay, it's not going to dive by, yields aren't going to come down by 100. I think we have seen significant stubbornness on the part of the 10-year to really come down once the rates are. So the ratio could only be like 25 to 50 basis points.
Okay.
At the most, you might get half of that, or you actually might not get anything, which is why they would have to come in with quantitative easing. Because the 10-year still represents uncertainty in U.S. policy and uncertainty in the economy. And unless there's actual buying of bonds, quantitative easing, it's going to be difficult to see the 10-year come down by as much as the front end comes down.
Okay. Right now, well, we're at Rule Symposium. What is your favorite commodity for the next 6 to 12 months?
Great question. Silver, I think, is going to have a bit of a highlight. I love gold. I mean, do not get me wrong. I think gold's going to be at 4,000 by the end of the year, turn of the year, from where it is right now. Last year, I think when we had this conversation, it was at 2,400. I said it would be 3,000 by the end of the year. It was. I'm looking at that progression increasing. But silver, where we've seen a lot of sort of sticking around the same band, has recently started to pop out of that band. And in fact, year to date, it's outperforming gold by a little bit.
Okay.
But the forces that are driving the upside in silver are real and they're accumulating. For example, China's come out with a 5-year strategy where they're always developing infrastructure, but where they significantly need more silver to continue to develop their energy infrastructure and industrial infrastructure from the standpoint of solar panels and the standpoint of sheer building.
Yeah.
So that's going to be an actual demand on the existing supply in silver. There's going to be a 200 million ounce shortfall in the demand versus supply ratio of silver this year.
Okay.
That's significant because you can't just turn around and create silver.
Yeah.
So what happens is once you go from surplus to kind of flat to deficit in terms of silver supply relative to ongoing long-term demand, that only gets worse until it catches up.
Yeah.
And I think we're just at the beginning of what we're going to see from that standpoint. That's going to squeeze silver prices up because there's simply not going to be enough supply to meet the real demand. From the retail perspective, there's been less interest in silver from the retail side because they're just trying to get their heads around gold, particularly Western investors. So that won't necessarily be where the demand pressure comes from, but it will come from nations and it will come from necessary long-term industrial development and energy development.
Okay. So we're at about a 200 million ounce supply deficit
By the end
of the year.
Yeah.
And what's the worldwide demand every year? Is it about 1 billion ounces, or is it?
It's something 1.1 or something like that.
Well,
So we're looking at a significant deficit.
That is a huge deficit.
It's a
if
huge
it's around 1 billion or 1.1.
It's really becoming significant again because there's been more demand more suddenly coming from nations that are building their energy and industry. The other part of that is also copper. Of course, we've seen copper spike up just this week because of news from the White House that there will be a 50% potential tariff on copper, and that has bumped up copper mining companies with viable mines and viable production, as well as the price. I think there definitely will be a lot of upside in copper. I don't know if that will fully be this year. However, one important date to look at for copper to start to accumulate along a path that will ultimately lead to higher copper prices is that the White House has been investigating the potential of copper under something called Section 232 of the Trade Import Act of 1962. And what 232 is, in a nutshell, is a study under which the White House, or basically the Washington, decides whether or not copper is necessary for defense. So is it a mineral that's critically necessary for defending the nation, basically? JFK came up with, he was president when the 1962 Act came out. We were in a Cold War. And basically the presidents utilized this to suggest for the first time in copper's history and 232's history, copper needs to be examined for this role in necessity for defense. If that happens, if the decree is yes, in addition to the 50% potential tariff, all of that will give a bid to copper. Because that will mean copper all of a sudden has a sort of a renewed status.
Strategic metal, yeah.
That's right, which is going to be a big deal. And then, of course, I still love uranium.
Yeah.
I've talked about that before. You should always have uranium and uranium mining companies in good jurisdictions in your portfolio.
Yeah.
And I think rare earths are going to have their moment. That's going to be a longer term moment. But there's a lot of shift happening if you're an early investor, if you're looking for early opportunities that are going to take a couple of years to come to fruition, then rare earths is the place to be.
Yeah, so last time we were talking, you had just started with Meteoric Resources, and I remember sitting through that presentation, and they were basically saying that all of it comes from China. You know,
right now,
all our rare earths come from China. And when there was a little hiccup with these tariffs, we got to see a prelude to probably what's going to happen with Meteoric Resources, and it went from a nickel to 10 or 12 cents in a day or two, because they have a resource that's down in Brazil.
Yes.
And that's not in China.
That's correct. It's
right?
not in China. It's very far from China.
Yeah.
Yes.
So you're still a part of them.
I'm still on the board.
Yeah.
I am still very enthusiastic about the company and the management of the company, but in particular that asset. So since we last spoke, We've continued to excavate the area, which is the caldera. Caldera stands for volcano, but basically it's this volcano 70 million years ago came and created space for which these rare earths came up. And the real unique aspect about this particular deposit base is that the rare earths are clay. And they're literally clay. You can literally pick up pieces of the mine in your hand and sort of like, they come out as clay. They have to be processed and separated and everything else.
Yeah.
But the good thing about that is there's no digging into rock and excavating hard materials in order to get to the minerals. Exactly. So it's way more economic. It's way closer to the Earth's surface. It's way more environmentally friendly. And it's way larger than it was last time I spoke to you. So the size of the deposit bases, we've continued to develop and to look for which pieces of it have the highest quality ore, has literally grown by about 35% in a year.
Oh.
Like, so the amount of tonnage we can potentially get out of that space that we have has gone from a ton to 1.5.
Okay.
Which is significant. If we continue at this pace with the land that we have under this project, we will actually be, and this is long term. Okay, this is not tomorrow, but we have the potential to be 10 to 15% of the world's global rare earth supply. That's not first step. First step, we're looking at 5%.
Yeah.
Once it's up and running, once everything sort of works according to development stages. But that's a significant situation, and that's grown since last time we spoke.
Awesome.
Yeah.
Awesome. That is pretty cool. Okay. Do you have any thoughts? Anything I should have asked that I didn't? Any final thoughts?
Well, one of the things I get asked a lot, Steve, and we've talked about this, I think, as well, is the timing of some of these investments. We know what's happening to the economy; it's slowing down. We know the job market isn't awesome. We know the debt's high. We know the deficit's high. We know all these things sort of in the macro world. But so where do you invest to basically combat that and to continue to actually grow your potential wealth, your family's wealth in the future? And I truly believe that is in hard assets, all of the ones that we spoke about. And the thing I'll say about that is that there's no time like the present to get involved. The demand for all of these assets for the different reasons by the different power players in the world is not going to go away.
Yeah.
And the supply cannot meet that demand quickly once it starts to deplete. And that's across almost all of the assets. So we really need to, as investors, be aware of the fact that, the train has not actually left the station yet, and you can still get on it.
Yeah. Okay. Awesome. Well, thank you very much for coming back on the show. If viewers want to get a hold of you and follow your work, how can they do so?
So you can look at my Substack, which is prinsights.substack.com, and there's different levels of work we do, including model portfolios that are primarily commodity and hard asset based, and we'd love to have you join.
Awesome. Thank you very much, Dr. Nomi Prins, and thank you for tuning in. Go to stevebartonmoney.com for more, and have a wonderful day.